You could pay a 40 or 50% tax rate in retirement due to something called the Social Security tax torpedo. I've done a lot of content on this, some Kiplingers, some other videos on this. This is something that most retirees need to know about, especially those who have been diligent savers throughout their life. Those who have accumulated a lot of money in tax-deferred investments that are going to lead to what are called higher required minimum distributions, RMDs. RMDs are when the government forces you to take out money at either age 73 or 75. And so what we're going to see with most of these people is when they take out money from their investments, it's going to force their Social Security to become fully taxable. And that's what we're going to talk about today, and how to prevent this Social Security tax torpedo and keep more of that money in your pocket. I do not want you to take out $10,000 extra dollars in retirement and only get $5,000. This is why we need to plan for the torpedo to make sure that doesn't happen. So first thing we want to look at is a chart here I have on the screen. So, this may confuse some people, but this is a picture or a glimpse of our software that we utilize to show where do our clients sit ongoing from a tax standpoint. We call it our tax map. And so with this tax map, you're going to see the purple there, and that's where Social Security taxation phases in. So how I explain this to most people is that if you have a lower income and your income's from here to here, you don't have to pay any tax on Social Security. And that's what this little phase in here, we call that the standard deduction. We call that provisional income, the lower bracket there, which I'll show you here next. And then you have that purple there. And then as you start reaching this purple, you start to have to pay more and more and more and more in tax on your Social Security. And then eventually it becomes to be 85% taxable. And then that 85% would count as income. And again, we want to try to avoid that, because if we can keep our income low enough, we don't have to pay 85% of that to become income. So that's what we're going to talk through here, but just wanted to give you a glimpse of what we're looking at here, and that when you look at tax planning, you're not just looking at the blue, which is federal income tax brackets. You need to look at everything playing together. So let's talk through how this torpedo looks, and then we'll come back to this slide as we conclude here. So the first thing we need to understand is how is Social Security tax calculated, and it's based on provisional income. So provisional income is not going to be found by looking at the federal tax, your federal tax brackets or your state tax bracket. This is something completely different. It's a different calculation that's used to take your Social Security benefit and then input it into your tax return based on whatever this number is. It could be 0, it could be 85% of your benefits taxable. We're going to talk through how to figure out what that is. So in order to determine what your provisional income is, you have to add up all these items together. Half your Social Security benefits. So if you have $40,000 of Social Security income, half of that is $20,000 will be used for your calculation. The next item is what we call ordinary income. Ordinary income is going to be income that you have, for example, pension, those RMDs I talked about, any investment withdrawals from your tax-deferred investments would count as ordinary income. Also, you could include here any interest from bank accounts, so we're seeing that quite a bit lately with higher interest rates. This could be income from working. Anything like that, you're going to be included in this category here. The next one is capital gains and dividends. So if you have any non-taxable or non-retirement type investments, that would be here. Or if you have maybe a rental property that you sold, or any asset that you sold that's going to be subject to that, that's going to be part of this calculation. And then the next one is non-taxable interest. Not everyone has these types of vehicles. Think of like muni bonds for these types of vehicles, but most people have majority of their provisional income come from these first three categories here. And so what we do, we take that number that you all calculated yourself. I hope you're good students on this YouTube channel and you are following along and maybe writing on a piece of paper. And so you take those numbers and you bring it to this chart here. Now with this chart here, you're going to see that there's different categories for married, filing jointly, and single. So just go to whichever category you sit in, and then what you look at here is if you're under $32,000 or under $25,000 of provisional income. So again, that number we just calculated. If you're under $32,000, $25,000, well, your Social Security subject to tax is actually 0. And that's what we like to be. We like to be in that area. None of your Social Security benefit would be counted as income in this scenario. And so that's a great place to be. Now, as soon as you start reaching $32,000 to $44,000 if you're married filing jointly, up to 50% of your Social Security Social Security benefit is subject to tax. Now, some people get this confused. If you only have, for example, $33,000 of provisional income, only that $1,000 is up to 50%. So it's a sliding scale. It's not you're not one step over and now everything's taxable at 50%. It's a different scale there. And then once you start getting over $44,000, up to 85% of your benefit will be taxable. And so if you remember that last slide I showed you, that's why you saw that purple progressively get worse and worse, the more your income goes, because now you're getting closer to up to 85% of it being subject to taxes. And so what we see here in this example here is that you reach that tier when you keep going and going and going, rise, and then 85% is taxable. You're no longer subject to paying more in Social Security. That's the maximum that you pay. And so if you're single, just follow those scales there. And so again, what we have to realize here is that this is not going to help us determine if our Social Security is taxable or not. We have to think of more advanced software, more advanced calculations to determine how all of this stuff plays together. We always consider this, is this the retiree's tax bracket? Well, it's part of the tax bracket, but it doesn't factor in Medicare premiums, capital gains, net investment income tax, Social Security taxation, as we're talking about today. So we need it all encompassed together. And then to come back to the first slide, the real retiree's tax bracket is this. How does everything play together? How do all of these decisions make a stand here? And so a few things we have to think about is, hey, do we take Social Security early or do we take it at 70? Because if we take it at 70, now there's no purple in this calculation here, and now we can do more Roth conversions or more tax planning to take advantage of our lower brackets while also increasing our Social Security. So that strategy may not make sense for everyone, but that is one tax planning item that you may want to consider when deciding when to take your Social Security, because now we can keep our RMDs lower than this torpedo here that you're seeing here. And so let me talk through this one a little more clear here to kind of wrap us up here, is that you remember how this purple goes. When you reach that provisional income point, you start to get some of your Social Security taxable, and then it goes up and up. And then we reach this, what we call the torpedo right here. And the reason why this torpedo exists is because now you're forcing Social Security to be 85% taxable. Now you're forcing yourself from 12%, into the 22% bracket. But also, you're forcing capital gains now to become taxable. So for most people, your taxable income, if it's about 90-some thousand or less, then your capital gains are 0%. But if you start to get to this point here, and your income goes over this, you're not only forcing Social Security more taxable, higher bracket, but you're also forcing those capital gains to become taxable when they could have been at 0. Now they're at 15% because you weren't paying attention to your income. And so we see a lot of people who come and see us from the YouTube channel we do, or podcasts, or the book I wrote, that come to us and say, I'm guessing. I don't know how all this stuff plays together. I'm not using software. My advisor's not using software. He just says I'm not a tax professional. You need to understand how all this plays together. And so for the majority of our clients, most of them are going to have huge RMDs in the future because they've been diligent savers. And so if that's the case, what we need to do now is to start to find ways to lower that RMD. And our goal for most clients is to keep our RMD at this point under this big torpedo, or obviously in the 0% tax bracket. That's a fun place to be when you can be in that 0% tax bracket and not have to pay any taxes for the rest of your life. So not reasonable for everyone, but depending on the amount of time horizon you have and depending on your situation, it may be wise to look to avoid the torpedo altogether and be in this area here. But again, our big goal is how do we pay the least amount of taxes possible? So for example, tax rates right now are 12, 22, or 24%. Well, as you can see on the screen, we're projecting, once you hit the torpedo here pretty quickly, you could be paying nearly a 30% tax rate just from the federal standpoint, Social Security. And if we can pay that tax rate at 24% now, would you rather pay 24 or almost 30, right? So these are the types of decisions we have to make now. So we get a lot of people that come to us and say, hey, I'm still working. I shouldn't do a Roth conversion. Well, that could be true for some people, but if you have a large amount of tax deferred, you may not have a choice, because once you retire, you're never going to be in a lower bracket because your investment withdrawals, your RMDs are going to be so high, you're probably going to make more in retirement than you are right now. And so we need to start getting ahead of this and utilizing this huge 24% bracket we have right now, because a 24% bracket nearly goes up to over $400,000 of income if you're married. And that gives us a lot of room, if you're not making that much money, to start getting some of this money over to a Roth, starting to diversify and putting our eggs in different baskets here so we can make sure we can plan for unknown tax rates in the future. So again, these types of strategies aren't for everyone. We're specifically talking to those who have more in tax deferred, $1 million plus, are those the ones that want to specifically look at this in more detail. And again, avoid that 40% tax bracket. So for example, we had a client right here on this chart here, and if they took out $10,000, they would force themselves to pay nearly a 50% tax rate. And so like I said earlier in the video, if you take out $10,000 and I only give you $5,000, is that a good deal? And the other $5,000 goes to Uncle Sam? I don't think you'd like that. We need a plan to make sure that we don't subject ourselves to this, because you're thinking you're only at 12%. That $10,000 you take out, I'm only going to have to send $1,200 to the government. Well, no, because of the Social Security, because of capital gains, you're actually sending $5,000. So do you really want to send $4,000 more than you have to? by poor planning. And so that's why having a plan in place makes this stuff work really, really well over time. So hopefully this video is helpful for you. If you do have specific questions or you want further guidance, feel free to schedule time with our team. You can do so in the link below. We do not work with everyone that meets with us, but we do try to help as many people as we can. And so you'll fill out a form and we'll see if we can add value to your situation. And then you can pick a time to meet with our team there. So that's all I have for today's video. Go ahead and subscribe, like the video, and we'll keep them coming. Have a great day. Hope you enjoyed the video today. As an avid viewer of this YouTube channel, we would like to offer you a free copy of our new book that just came out called I Hate Taxes. So if you would like a free copy of this, then go ahead in the description below. You'll be able to click on a link to get that free copy of this new book, I Hate Taxes.